you would have had to wait 3 years just to break even instead of making a $24,000 profit. Here's another stock. I told you about the Starbucks stock that I did recently, but I also took a position recently in ActiVision. ActiVision, I looked at the stock. It looked like a fairly erratic stock that was moving up, but right in this period here, it was just doing absolutely nothing. And I initiated a position right in here when I could see that there were larger dark bars here. Looks like there was a very light accumulation of the stock in this period, and I purchased the stock right in here, right around $27.24. Well, I didn't have to wait too long, maybe about a week and a half, before the stock just absolutely took off and skyrocketed upwards. So if it had fallen, then I would have cashed into my insurance policy. I would have purchased additional shares of stock and held on to the stock because I believed in the stock. I believed that the long-term value of the stock would have increased in price. And that's the only kind of stock that you really want to put on in these types of positions. You want to be able to go in to buy stock that you believe in, that you believe has an absolute opportunity to increase in price. I would not have purchased the stock in this, at $27.25 if I didn't believe that it would have a future, good appreciation over the long term. Because even if the stock did break down and go back into this lower channel line, it would have given me the put that I had in place as insurance would have protected me. I would have only lost about $400, but I could have cashed in my put position in order to accumulate additional shares of stock. And then as the stock rose, instead of 1,000 shares of the stock, I would have had maybe 1,500 shares of the stock, and I would have made even more money on the future increase of the price of the stock. As it was, as the stock began to increase in price, then what I did was I simply rolled up my put position using the profits. I've already had profits built into the position, and I used those put options. I just simply cashed in my old put options and rolled up my existing put options. But now, because I have a good deal of profit, the stock did prove itself to be a good performing stock, I didn't have to have the put position as close as I used to have. In other words, let's say that let's say you bought Starbucks at $15, you've got a built-in profit here on the stock. You don't have to buy something that's in the money anymore. Now you can go down a little bit. You can go back down to the $16 strike price and buy those cheap options, but only after it's proven itself and moved up in price. This is the way professional traders make money in stocks, whether they go up or down. Because if they go down, all they do is cash in their put insurance policies to purchase additional shares of the stock. And if it goes up, they make money, and the insurance really didn't cost them that much, did it? On initiating positions, you want to make sure that you purchase something that you feel comfortable with. In my case, I'm comfortable with a $400 loss in this position, and I would purchase this stock with the put option as protection. I would have a maximum loss of $400. I don't care where the stock went. This put option would increase in value. I would cash it in to buy more shares of the stock because I believe in this stock. I believe it has future upside potential. I'm not talking specifically about Starbucks, but let's say any stock that you were interested in purchasing. Here are some of the stocks that I've been looking at lately. I've been looking at SWN as a short position, actually. I've been looking at Urban, ADSK, Netflix, WDC, Starbucks, and a couple of indices. Now, can you do this with indices? Yes, you can. Let's say you thought there was a really good potential for the home builders, home builders ETF, HXB, which is the home builders. They've gotten decimated. I mean, they've gotten absolutely killed with the credit crunch and the problems with home prices in the last few years here in the market. You could do the same thing as long as there are options trading on a particular ETF. This is an ETF. It's a SPDR ETF. You could do the same thing. You could purchase put options on this ETF, which is currently trading at $18.13, and you could purchase the $18 or even the $19 in the money put option as insurance. Now let me just show you something else, because the TOS platform does make this extremely easy. What it doesn't tell you is how to adjust these positions, which I've just went through an exhaustive detailed study of. You go to buy covered stock. It automatically brings up the stock with the strike price at which you just selected. If you wanted to purchase 700 shares or 600 shares, it would automatically calculate the number of put options that you need to purchase. The important thing is to analyze the trade. You want to go over and analyze the trade so that you know exactly what your maximum loss is on the trade when you initiate it. On 1,000 shares, my maximum loss here would be $790. I'm not particularly happy with that. I might go to the $20. At $20, my maximum, the $20 put would give me a maximum loss of $500. That's only when I initiate a position. If this it does cost a little bit more when you initiate a position, but guess what? Let's go back to the chart again. If XHB does increase in price and it goes back, let's say it goes up to like the 21 level. Well, at the 21 level, I have approximately, let's say if I was doing 1,000 shares, at the 21 level, I have $3,000 in profit. Okay, it cost me $2,400 for my insurance, but now that I have a $3,000 profit locked into my stock position, my ETF position, now when I go to roll over my put position, because the stock has already proven itself, well, maybe now I can go down to the $18 level or the $20 level at that time, which would be a little bit cheaper. I can purchase a put option as insurance slightly under the market because I already have a profitable position built into it. However, this is not an attractive proposition for me. I'm not recommending HSB, and I would not do this for one reason. The volatility level of this particular stock is 50%. That is way, way too high. That's much higher than I would feel comfortable doing. If we took a look at the XLF, which is another ETF that I'm taking a look at, that has a volatility level of 43%. Why is that important? Well, it's important because the higher the volatility level, this is not the delta. The delta is this column here in yellow. The volatility level here is the numbers that I'm looking at. This volatility at 43% affects the value and affects the price of the options, especially the put options that you're buying. It increases the price of the options. So in other words, you're paying a huge premium in order to protect your investment here. And I would not pay that much in order to protect this investment. I would look for other opportunities. Let's take a look at a stock that has been going up recently. Just as an example. Let's take a look at Netflix. Netflix has had a pretty good run. It dropped off a little bit, but it's starting to kind of stabilize here in this area. Let's say I had a really good idea that Netflix is going to increase in price here. Let's take a look at the volatility for Netflix. Volatility for Netflix is still pretty high. That's 53%. That's a little bit too high for me. Let's take a look at another stock. Let's go to Urban Outfitters. Urban Outfitters is another stock that's been, increasing dramatically in price. It's fluctuated pretty good in here, but it has on the whole generally increased in price pretty good. Let's take a look at the volatility of Netflix. Netflix, again, volatility is up around 45%. Now that may be the result of the market as a whole declining, I don't know, but those are pretty high volatility levels.